don't have your placards, let me know. I have obviously quite a few more. As usual, we will start by going through a quick summary of the material that we've been covering to give you context. In terms of the material, we've looked at several chapters now. You guys are getting an idea. Hopefully you're getting a good idea of what tax is all about. Your placards are behind you. Okay. Okay. I guess that works. I got to get used to it. So, in terms of the material, Chapter 1 is an overview of our tax system, talks in general terms about sources of authority, talks about tax policy. Chapter 2 deals with issues of what is includable in income generally, and we learned that under Code Section 61, virtually everything's includable in income. Next, we move on to Chapter 3, and we learn, notwithstanding the breadth of Code Section 61, that there are several code sections that exclude things from income, okay? Including Code Section 102, Code Section 119, so that not all accretions to wealth are subject to tax. Chapter 4, we look at yet additional items that might not be subject to tax, including, for example, meals and lodging provided for the convenience of an employer, Code Section 119, as well as Code Section 132, fringe benefits if it meets the parameters of certain given definitions. So that's our first, second, third, and fourth chapters. We skip Chapter 5 dealing with awards, knowing that virtually all awards are subject to tax, but for a very, very narrow exception. And then we moved in last class to talk about gains and losses, right? Computing gains and losses and what's taxable and how much is taxable. We see that the operative code section here, Ling, is what? What code section? Dealing with Ling? Yes, you. Forget about capital gain. Computing gains and losses are under what code section? What's the operative code section? 1001, right? And Ying, generally the definition is what? How do you compute gains and losses? How do you compute, Sierra? Amount realized less adjusted basis gives you gains and losses, right? And we looked at several different code sections, how to look at what is basis, right? What is tax basis first? And some of those code sections, for example, Liz, if you buy something, what's your basis? You don't know? Carol? If you buy something, what's your cost basis, Doyle? 1012, your cost basis, right? That's the starting point. And Ran, if you have depreciation or improvements, any changes to basis? No. Ran? If you make any adjustments, gains, appreciation, improvements, how? Patty? What happens to basis? I mean, let me just say, guys, our exam is in 2 weeks, right? So now's the time. If it weren't before, it's time to take it real serious. I sent an announcement around about how the exam is going to be handled. There's no extra credit. I'm going to try to get a different room. I'm working feverishly to get a different room, a much larger room. And we'll see where that takes us. But, you know, the exam is the exam. It's going to be up to you to know this stuff and know it pretty cold. Right, Annie? If you make improvements or changes, what code section? Annie? Yes. I think there's only one Annie here. 1016, right? You make adjustments in accordance with code section 1016, right? So Code Section 1016, you make certain adjustments to property upward or downward, right? And if someone gives you a gift of property, what's your basis in general run in the property? What? David. That's your cost basis. That's not it. Eric? Mike? MJ, if they give you a gift, what's your basis? 1015, generally carryover basis, except Mike, when is that not true perhaps? It's a gift, so no one's dead yet, right Matt? So is there any exceptions to the general rule of a carryover basis? Is that always the operative rule, Larry? Is there any exceptions to the general rule under 1015A? Okay, if the fair market value is less than the adjusted basis and the property is subsequently sold for a loss, you use the fair market value. Martina, any other exceptions, or is that the only exception we learned about? What, divorce? No, I'm just talking about it in the context of a gift. Is always a carryover basis rule. What do you mean by 1015C? What am I referring to, Kevin? Second exception that we learned about? Only the loss? There's no others, Igor?
I'm not sure.
Nothing else? John? What about it? When does that come up? You're talking to a client. When does that second exception apply? When there's an adjustment to basis? Go ahead, Matt. Excuse me? That's in the context of 1041, and Martina, I think that's what you were referring to. I'm talking about actually in 1015. Is there another exception that we learned about? How you know, Kevin? That's a 1031 exchange, but that doesn't come up too often. That's not what I'm referring to. Guys, we were talking about Chris. If you make a gift, is there another exception where the basis changes? If there's gift tax paid, right? The gift tax paid on the appreciated portion causes an upward adjustment in the basis, right? Your note should reflect those two exceptions, right? 1015D6, right? Now, the basis rules. If someone dies and bequeaths you property, Matt, right behind you is whom? Where's your placard? Is it hiding there? Jimmy, what's your basis? I die, I bequeath you property. What's your basis in that property? So you just got to snap this stuff out. It's got to be second nature. Stefan? Is it what I bought it for? Jarrett?
Fair market value.
It's fair market value, right? Fair market value. Arish, is that always my basis? The recipient? When isn't it?
Unless the person bequeathed less than a year, 14E, 1014E.
1014E, which says, right, if the person dies and having gotten it a year earlier from you, then there is no basis equal to fair market value rule that applies. All right? And then for my, and for the class, everyone's edification then, in this case, he. What is the relationship between Code Section 109 and 1019? What is that relationship? What is that relationship? Nina? Guys, again, this exam is very quickly going to happen, right, Amanda? What is the relationship between 109 and 1019? Amara? Jared, did you hear that? Got to talk loud. Pretty, say again? Say it louder and say exactly what you mean. There is a what basis? That doesn't say much. And what does that mean with respect to Code Section 109? What's the relationship, Amanda? Okay, to whom?
To the owner of the property.
Okay, the lessor, right? Code Section 109 says the lessor does not have income, right? And Code Section 1019 says there's no adjustment to the owner's tax basis, right, as a result of that improvement, right? Generally, you know, under Code Section 1016, improvements generally cause an increase in tax basis, right? But that's not true when it comes to a lessee making improvements on the lessor's property, right? And we know as well, hopefully we know as well, that when property is sold, when you're computing amount realized, in addition to cash and property you receive, Emmanuel, what does amount realized also include? Not sure? Bill? What else, Gary, doesn't include? Joe?
Can you repeat the question?
What does amount realized include aside from cash and property that you might receive? What else? I'm trying to get somebody. I can't. No. What else does include the amount realized, Jarrett?
If they cover the mortgage or
Liabilities assumed, right? Right, liabilities assumed, right? And Jing Jing, if you want to impress someone, right? What case are you going to cite to for that proposition?
The Crane.
Crane, right? You're going to cite to Crane, right? And people are going to be impressed because you know Crane, right? Everyone agree? So Crane, for the proposition that gains and losses, right, you got to take into account under amount realized, right, the liability assumed by the other party. Remember, we went through a whole bunch of examples, including part sales, part gains, even though there was no actual cash exchange, when, if you recall, the son accepted the property that was subject to a liability of $180,000, the mother was treated as having an amount realized of $180,000, right, Jing Jing? Right. So that's going to be disastrous on your exam if you fail to take that into account, right? It's not going to be a happy day for you, or for me. I sound like Bill Clinton. I'll feel your pain, but I want you to succeed. I don't want to feel your pain. I want to thrive in your success. All right, so we looked at those issues in Chapter 6, obviously an important chapter because your clients are always going to want to know what are the tax consequences associated with their sale or disposition of property. Then we moved on to talk about what is the character of the property. So numerically, once we had the gain or loss computed, then we had to figure out the character of property. And for our purposes, Shangnan, what is the character, what did we learn about last class, the consequences, what are the characteristics, what kind of property, what kind of income can you have, just generally? What are the two classes of property? What kind of income? What kind of property? Jing? Capital, and what's the other kind? Ordinary, right? Capital or ordinary, right? And is it generally good, Jing, to have capital gain or ordinary income? Which is generally, would you prefer, Jing, and why? What would you prefer to have, Jing? Capital gain or ordinary income? And why? Seba, could you hear her? Jing, shout.
Because capital gains will be reduced by capital loss.
So why would you want ordinary income? Is that what you want to say, John? Is that what she wants to say?
So that's a reason why I should want capital gains.
Why would you want capital gains or ordinary income, John? Capital gains and why? You're taxed less? Wei Jin, you agree? You don't agree?
I thought you got a higher tax on capital.
A higher tax on capital gain? Ben, do you agree?
I would go with withdraw.
I'm sorry?
I would go with withdraw.
So what's your authority? MJ? Code section 1H. Okay, code section 1H for the proposition that there's a preferential rate, right? In general, for our class, NECA, what are capital gains taxed at? What percent? Capital gains. Generally 15%, except with respect to Howard collectibles are taxed at what rate? Is that what collectibles, Tim, are taxed at? 28%. And the highest marginal tax rate, Caitlin, is now what? 35, right? When Romney talks about a 20% reduction in tax rates, he's talking about taking that 35% rate and making it 28%. Last I checked, 20% of 35 is 7, right? All right, so capital gains have this preference. Justin, does that mean all taxpayers want corporations? Do they get a preference in the rate they experience when they sell capital assets?
All corporations do not.
They do not. What's your authority for that? David? Jenna? 1201, right? 1201, same rate. That being the case, here's a critical question. Nina, do corporations care? They do? Why? Pretty, do they care? And why? Joe, do they care? Seva, could you hear that? If you're talking to your clients, you got to talk loudly, guys. Son? They don't care. Do you agree with that?
I would say they would care,
Why?
because they use their capital losses.
Oh, they do care because otherwise they can't use their capital losses. What code section? Doug? 1211. 1212 talks about the carryover. Right? Now, again, we can talk all day, but we're not about whether or not there should be a rate preference, right? A lot of debate. In this Sunday's New York Times, there is yet one more of the hundreds of articles, thousands of articles talking about the pros and cons of capital gains having preferential rates. You guys can be your own judge. about whether or not it has merit, but don't look for an exam question. Ask, it's telling me about the policy reasons. The exam questions will be hopefully much more practical. All right, before I go on and cover new material, our agenda today is to talk about what is a capital asset and talking about what qualifies for the preferential rate. So that's giving a little foreshadowing of what's to come today. And then we'll continue this dialogue our next class because, again, this is critical for you guys understanding our tax system, the nature of capital assets and the like. Any questions before I move on to the new material? Everyone's raring to go? Everyone has this stuff down? Good.
Are we allowed to use our notes as well?
You're allowed to use your notes. I sent an email around today, guys, highlighting my rules, which we're going to try to, first of all, to get a different classroom. I'm working on that. And again, I said time does not matter, meaning the exam, I already know that room 220 is not available upstairs for this during 12 to 3. So you have to be flexible. The exam might be at 9 in the morning. It might be later in the day, but I'm going to try to get as close to 12 to 3 as there is a room available. But the exam itself is going to be open book, open note, nothing electronic, except for if you want a simple calculator. You're to come to the exam early. You're to come to the exam, having used the restroom. No one's to leave. And the rules are set. There's like 6 or 7 what I call generic rules. If you have a question or problem about the rules of the exam, just shoot me an email and I'll hear you out, okay? But again, let me emphasize, because inevitably 2 to 3 people will say after the exam, can I get extra credit? Can I do something else? And I say, I wish with my clients I could say, if I did something wrong, can I get some extra credit? And clients will just simply fire you. I mean, they don't give you, you don't get a second chance with clients. So don't put if you can, don't put yourself in that position. Pretty?
Is there all multiple choice questions or comments?
There's going to be a combination of true, false, multiple choice, and so-called essay questions. All right, where the essays, it's really a misnomer because I'm going to be looking for, quote unquote, the right answer coupled with authority for what that answer is. Generally not, because you're too big. All right, so no. The other thing about it is, most people will say that there'll be a lot, like you won't have time, this will not become a research project, okay? So the exam, you will not have a lot of time to look at your notes. That's intentional. You're supposed to look at your notes maybe once or twice during the exam, but you will not have the opportunity, if you don't know the material, to say, gee, it's open book, I'll just, given enough time, in theory, everyone here should get 100% because you have the material. So I have to run the balance between open book and giving people who really studied hard, come to every class, and really prepared the upper hand, so that you have to know it and hopefully know it cold, right? The person who gets an A is that person who, in my opinion, can impress the person at the cocktail party because they really know it and know it inside and out. I will be around the next 2 weeks, the rest of the semester, so as the days unfold, if you get stuck on things and you can't figure things out, shoot me an email. And for example, this weekend I got an email, and I was really tempted not to open it. Why? Because I was sure it's junk email. Someone sent me, or spam, someone sent me an email on the subject line. It read just simply 1H. Now, I looked at it quickly and I figured there was nothing to me to say that was taxed. I mean, just didn't seem to me like that was going to be a tax issue. And then I don't know, I couldn't resist, so I did open it. And someone, of course, had a question about code section 1H. But that's probably not, if you're going to give me a code section, which is fine, I love code sections, but put it in parentheses, student from, PA class or something like that, and then there's a much better chance. I'm telling you, it was really, I had my misgivings about opening that one. All right, so if you don't hear from me generally very soon after you send the email, feel free to send it again, and then call me and leave me your number where I can reach you, and I'd be happy to get back, okay? Again, my goal is to have everyone here be a success. That's what makes me feel good, not that if you don't understand things and you don't do well on the exam, that, you know, I don't get the warm cuddlies from that. So whatever time you put in, if I can help you succeed, that would be great. Before we go on, I will share, I had a chance, if you guys haven't, cultural this weekend. I did see the movie Bernie. Did you guys, anyone see that movie? Jack Black? No one, did anyone see that movie? Zero? Bernie is about the guy who killed his companion and stuffed her in a freezer for 9 months before he was discovered in a small town but it's not a oh my God kind of story, because he was the most beloved person in this town in East Texas, and he took her money and spent it on all the townspeople, and it's a true story. And when he was discovered, and he wasn't really hiding it, he was a funeral home director, and he didn't put her in the freezer because he was malicious. He just did it because she was such a bad it's a long story, but it's a very interesting psychological story. So if you on demand want to see it, it was also written up in the New York Times, so it was interesting. Anyone see anything or do anything this weekend aside from watching the Jets get pummeled and the Giants lose? Go ahead, Joyce. And anything happening there? Football game? Okay. A lot of people I know go to Penn State. They really like it there. Any other cultural events? Nothing? Which festival? Mid-Autumn Festival. Where was that?
It's a festival. It's a Chinese tradition.
Where was it held? In New York City or?
In Harrison.
Harrison. Oh, all right, nice. Again, guys, apple picking time, all those good things. Any event, let's get back onto tax. Let's get back into tax. Okay, so we talked about capital gains. We talked about the rate preference. We talked about capital losses. And are you at liberty to just use your capital losses at your discretion? Can you just willy-nilly use your capital losses whenever you wish, Sierra? What code section puts the brakes on? Doug? And what about corporations? Forget about the carrybacks. They can't use any capital losses, right, except to the extent they have capital gains, right? So we talked about code section 1211, which puts limitations on the use of capital losses, and code section 1212, which presents us with a, in the case of individuals, carry forward. How long, Eric, can you carry that capital loss forward for? Is that true, Mike?
No.
How long, David, can you do it? Is that true, MJ? Individuals? Bill?
It's forever.
It's forever, till you die.
Until you die, yeah.
All right? Capital losses for individuals can be carried forward forever. Jeffrey, what about corporations? What about them, John? What about capital losses?
Capital loss, 3 years preceding the loss, and 5 years after the loss.
Yeah, it's 3 years and 5 years, right? That's with respect to corporations. And that's distinguishable, by the way. Some people get confused about net operating losses. Under Code Section 172, if you have a net operating loss from business, the net operating loss can be carried back how many years and carried forward how many years? Carried back 2 years and carried forward 20 years. So the code has many different carry back and carry forward rules, even with respect to something called the foreign tax credit. That's under Code Section 904. You're not responsible for this, but I'll just give you another example. Carry back 1 year, carry forward 10 years, right? So for our class, you're just learning one, which is 3 years and 5 years with respect to capital losses. All right? On page 730, there's a problem. We have 2 questions on capital losses incurred in the current year. The figures are taxable income in column A for a single taxpayer's taxable income for each of 2 years without regard to capital gains and losses. Note that in computing gross income on the tax return, gains will be included since capital losses exceed capital gains, and the 1211B excess amount will be a reduction. And again, keep in mind for the exam, you're not going to have to do any serious number crunching. All right? I've already said that in that respect, your tax software programs are going to do that for you. So we have taxable income of $10,000, net capital gains of $2,000, net capital losses of $6,000, short-term capital gains of $2,600, short-term capital losses of $1,000. So Code Section 1212, if you take a look at Code Section 1212, provides a netting process, right? And you net long-term gains against long-term losses, right? And if you do that in this problem, problem 1, what's your net long-term capital loss? 4,000, right? Net long-term capital loss. And with respect to short-term capital gain, short-term capital loss, what do you have there? 1,600 what? Short-term capital gain. Everyone agree? Which leaves you what? Under Code Section 1222, you can net them, right? And you have 2,400 long-term capital loss. Can you use that loss, if this were a married couple, can you use that loss against this taxpayer's ordinary income? Yes, you could use this against the taxpayers. If this was a joint return, you could use all 2,400. If it was a single taxpayer's return, you could use 1,500, right? And have to carry the other 900 carry forward. Okay, for your notes, if this were married taxpayers, you could use all 2,400 and offset your $10,000 of taxable income, right? Leaving $7,600 worth of taxable income. If this were, again, a single individual, you could use only 1,500 and carry forward the other 900, right? The carry forward would be under what code section? 1212, right? Everyone agree? A single person gets 1,500. All right? Let's go to question 2. Question 2, if you look at the netting process, what happens? You have how much? $8,000 worth of long-term capital loss and how much short-term? Now, what ends up happening here, and the code is kind of, if you're in a congressional committee, in particular the House Ways and Means Committee, you have to come up with a device here, because part of the answer we know here. We know this taxpayer can use, assuming this were a married taxpayer, okay, in question 2, how much of the $10,000 of capital loss can they use? Everyone agree? 3,000, and they have to carry forward how much? 7,000, okay? But question, which of these do they use? Which of these do they use, Liz? They first use the short term. And Liz, what's the code section that gets you there? In other words, you're absolutely 1,000% right. 1211. I don't think you mean 1211. I think you mean about 1212. 1212B, right? 1212B, right? Which says, Code Section 1212B says, for purposes strictly, only for purposes of computing the carryover. It's not going to end up on your tax return. It's a worksheet. And it says constructively to get us where you want to be. And then we'll talk about the general rule in a moment. It says essentially for computational purposes alone, create, this is under 1212B2, create a short-term capital gain. $3,000 a short-term capital gain. And determine what happens under those circumstances if you have $3,000 worth of short-term capital gain. And if you had $3,000 of short-term capital gain, well, what's the netting process here? $1,000, right? A short-term capital gain. And then what would be left if you netted this against that? $7,000 worth of long-term capital loss. And what Liz, I'm putting gain, what Liz is suggesting, which is correct, is that the bias in the code is to carry forward long-term capital losses. And the way the code gets you to where it wants to be is to artificially create short-term capital gain. It's just an exercise, and without going through the code, the rule of thumb is, when in doubt, always use the short-term capital loss first, and then and only then use the long-term capital loss. So the bias in the code is, when you have both short-term and long-term capital losses, use the short-term capital loss first, then go to the long-term capital loss, and you have the correct answer. Sierra? No, I mean, you don't create 5,000 because you're netting a loss against the gain, so the netting process produces, in this case, a gain. The message here, guys, is at the end of the day, if this taxpayer has had $10,000 worth of gross income, salary income, you could take $3,000 and use it against $3,000 in capital losses, leaving them taxable on $7,000, and you would carry forward $7,000 of long-term capital losses. So everyone hear that? That you would have $3,000 of usable capital losses that you could use, made up of $2,000 of short-term capital loss and $1,000 of long-term capital loss, leaving for next year, under Code Section 1212, $7,000 worth of long-term capital losses. All right? Jenna?
Where'd you get the 3,000 from?
This is we're artificially constructing this. Sierra would tell you, Code Section 1212, or Liz would tell you, Code Section 1212B2 says when you have both, create this. This is an artificial construct out of thin air.
Why 3,000?
Because it says, when you say, look how the code says, use the lesser of. The amount allowable for the taxable year, if you look at 1212B2A, use the lesser of the amount allowed under paragraph 1 or 2, which is $3,000, or the taxable income, or the adjusted taxable income, excuse me, which is $10,000. All right, so the lesser of the two is going to create $3,000. Okay?
Thank you.
All right. So look, guys, here's the takeaway. Capital gains, for our purposes, has a preferential rate, right? And generally, for our purposes, 15%, except in the case of collectibles, 28%. Corporations and individuals have capital loss limitation rules, right? Code Section 1211. 1212 allows individuals to carry it forward indefinitely. Code Section 1212 allows corporations to carry it back 3 years, carry it forward 5 years. And then there's this special rule, if you have both long-term and short-term, which ones do you take first? Well, generally you take the short-term first, letting the long-term go longer. The long-term not go longer, but be used in the next year. What was the congressional policy? about that is if you carry forward the long-term capital loss, that's actually not a good thing for the taxpayer because those long-term capital losses will be used to absorb the taxpayer's long-term capital gains. Long-term capital gains are where the rate preference is. If you have short-term capital gains, what happens? How are short-term capital gains taxed? Just like ordinary income. They do not get a rate preference. So the bias here, Congress had an agenda of trying to force taxpayers, this is not a tax favorable provision, that they're going to be taxed on that on potentially a higher amount the next year because you're going to force long-term capital losses forward for the next year. Meaning of a capital asset. Okay, now that we know some of the consequences associated, right? Some of the consequences associated with being a capital asset, you know, kind of maybe if I were the authors, I would have started off with what is a capital asset first and then gone into the consequences, right? I sort of think it's important to know what is a capital asset before you start delving into what are the consequences. But look, I'm not the author of the textbook, so I got to grin and bear and accept it as is. So we now look at what is a capital asset. And if you recall from our last class, definitionally, where is that Travis spelled out? What code section? Travis? And Travis, is capital asset broadly or narrowly defined? Say again? Why do you say that? Is that right, Kyle? Is that? So you're saying it's broad in scope. Everyone agree? Broad in scope. The definition of a capital asset is broad in scope, right? Virtually, when you go outside today, when you're driving your car today, when you look around the world, what do you mostly see out there, guys? Capital assets, okay? So there's a field exercise this afternoon as you're driving home. Look around. Don't close your eyes when you're driving. Look around. And what you will see is mostly capital assets, okay? There's three big exceptions in my mind of what are not capital assets, okay? Three big exceptions. You want to say what is the first big exception that comes to mind? No particular order. What are three big exceptions to what are capital assets? Because when you look around today driving home, not everything you see may be a capital asset. So can you just tell me one thing that you might look at when you look at it and say, gee, that's not a capital asset? Anything, you? What is not a capital asset? Can you give me an example of what is not a capital asset? Arish has got his hand up.
Property and the nature of
Inventory, right? Right? If you go to Home Depot or the supermarket this afternoon, guess what? When you buy your apples, are those capital assets, those apples? No. Okay? So you buy those apples, not capital asset. Everyone agree? Inventory is generally not a capital asset, right? Ling, do you have another example of something that's not a capital asset? Again, you want to make your trip home exciting, so Jenna's got her hand up. And
Copyright?
but that doesn't come up a lot. I'll say there's, admittedly that may not be, but what comes up much more often, because but that's inventory. Stock, in the way that's phrased, that's inventory. Go ahead.
Property that you use every day for like your business.
Such as, give me an example. Well, cornfield's not a great example. Go ahead, Larry. What? Plant and equipment, right? Machinery, right? The cash register that Home Depot is using, right? The broom at the supermarket. Assets used in a trade or business are not inventory. Okay? Let me repeat, because a lot of people on exams screw this up. Hopefully you won't. Now, be forewarned. I'm going to give you a foreshadowing of what we're going to begin to look at next class. What are those assets called? Assets used in a trade or business. At the cocktail party, Jing Jing, you want to look good? What will you refer to assets used in a trade or business as? Give me a code section number that you can get away in name dropping at the cocktail party and impress your friends and neighbors. Go ahead, Larry. No. That's depreciable assets. Go ahead, Doug. What? 1231 assets. All right? So if you want, and you got to know this by heart, okay? 1231 assets, or assets used in a trade or business. So, Jing Jing, when you go to that party, you can say, oh, those are 1231 assets. And guess what? A little foreshadowing. Is 1231 classification a good or bad thing for taxpayers? Generally, good or bad? Thumbs up or thumbs down, like the Roman gladiators? Stefan, you're saying down. Why? Larry's saying up. Saying down, and I got Larry. You got to give me a reason. You can't just. That's not a bad thing, but even better. What happens when you have a game with a 1231 asset? What does your book say? 1231 says. What kind of treatment do you get with your 1231 asset? You get long-term capital gain treatment. That's a good thing. And if you have a loss with 1231, guess what kind of treatment you get with 1231 assets? Ordinary. Holy cow! You're telling me one asset has the equivalent of commanding capital gains treatment and possibly ordinary loss treatment? Isn't that a slam dunk for your clients? If they sell at a gain, they get a capital gain. If they sell at a loss, they get an ordinary loss, right? It's like a platypus, right? It's not like easily classified, right? Yeah, I know, Liz. You're thinking, where do I come up with that analogy? That's okay. So that is a pro-taxpayer provision, right? Everyone agree? Because you're getting the best of both worlds. So, Stefan, before you give it the thumbs down, notice it does have this preferential treatment. But is it a capital asset? Is it? Is it? Justin, is it a capital asset? Hell no, right? Because it says so right there in the code. 1221 says assets used in a trade or business are not a capital asset. But there's 20% of you, maybe 25% of you, who don't want to listen to me. I mean, I don't know what else to say, but on the exam, they will put a 1231 asset as being a capital asset because it commands capital gain treatment. It is not a capital asset. I don't know why you resist. You can tell me now, but on the exam, I don't know why, again, a quarter of you or more will put down that you believe it's a capital asset, but it isn't. 1221 says specifically it is not a capital asset. And every year I want to bang my head against the wall and say, what could I say differently to convince people? I don't know. Do I want to pause here and tell me why I'm missing something, why you guys want to resist? All right, so no one here, I'm going to have the first perfect class I've ever taught, and no one here is going to make that mistake. Is that a commitment? It's like the Republican pledge, no new taxes. You guys are going to commit to something else. No mistake on 1231 assets. I don't hear a resounding vote of confidence, but that's what I want to hear. So that's number 2 asset, right? Inventory, not capital asset. Assets used in a trade or business, not capital asset. And the third, accounts receivable, are not capital assets. Now, there's others, right? Listed under Code Section 1221, but they don't come up with as much frequency. You can look at them, right? Now, I left you with a question, and then we'll get back to the book. my curiosity about St. Barnabas Hospital last time, I left you with that issue about women selling their eggs at $5,000 a pop. All right, given what we've learned, given the fact that you have had a restless week contemplating that issue, does anyone have an opinion whether or not women's eggs should be treated as capital asset or not? Certainly is a gain, one would argue, because you might argue you don't have a tax basis in your eggs. So, Raquel, how would you report that on your tax return? What? You would put capital. Does anyone disagree with Raquel? Would anyone else take a different position on their tax return? So who would take a different position, or would you all take the same position? So Raquel wants to take a tax favorable position, and you're her accountant. Do you allow her to take that position, or do you take a different position? Well, we know there's going to be a tax, but the question is how much, right? How do you think St. Barnabas reported it? Okay, forget about what is the correct treatment. How do you think St. Barnabas reported it? And I know a physician there, and I called him up, and I said, just out of curiosity, what is St. Barnabas doing? So he told me. What do you think St. Barnabas was doing? And you want to be politically correct here, Joyce. But are your eggs really used in a trade or business if you sell them? Now, keep in mind, St. Barnabas wanted to play it politically smart. They didn't want to be perceived as in the business of selling babies, right? That doesn't get you good press. So what do you know, some of you women, and maybe some of you men, is it easy or hard to give eggs? Hard. Why is it hard? Right, you had to be juiced up with Clomid, okay, to get your ovaries cooking. Oh, okay, I didn't. Hold on, I don't know what's going on with the Kardashians there. Okay, so she had to get her eggs. She had to get them ready. Okay, so she had her eggs taken out, right? Okay, so it's not an easy process to cultivate and then to get the eggs out, right? You need specialists, and it's labor intensive, right? Hint, hint. What do you think? How do you think St. Barnabas reported that then? As service income. You're being paid for your services, right? So you're rendering, the hospital is going to issue you a 1099 miscellaneous for your services, right? Everyone agree? Okay, so that's what St. Barnabas did. That doesn't make it right. That's what St. Barnabas did. And by the way, at a certain point, might you say that's not the correct treatment? And let me give you, St. Barnabas might say, gee, you have to give like 20 hours. I don't know how much Kim Kardashian or others had to give, but it might take 10, 20, I have no clue how many hours to. You might say 5,000 is reasonable compensation. But about a year or two after this article was published, there was someone who was advertising at various Ivy League Ivy League colleges saying, willing to pay $50,000 for Ivy League graduate eggs, okay? Okay, so it was upping the ante. So at a certain point, it gets away from services, and now all of a sudden it really looks like they're beyond services. They're really paying you for your eggs. Now what's the correct tax treatment? And at least, can you say that there's, what are the arguments in favor of capital gains, and what are the arguments against capital gains? What's the best argument against it being capital gain, rather being ordinary income? What would be your go-to argument to say this is going to be taxed as ordinary income? Go ahead, MJ. So, but Pigeon, use the code and come up with an answer. But it's not a basis issue. We're talking about character now. So what code section will you look at? mean, what code section are we looking at right now? Hint, hint. 1221. And if you want to say it's not a capital asset, what might you rely on? What code section? Go ahead, Larry.
Say it's not property.
What?
Say it's not property.
What do you mean? Where would you fit it?
The exception.
Well, which exception? Is it a copyright?
Say it's not. Say it's not property.
What do you mean? It is property. We know that, right? An egg is property. It's not an intangible. Inventory, right? I mean, that's the most natural to say it's inventory, right? Okay, right? Everyone agree? I mean, you're using the code, right, MJ? And you would argue that it's inventory, right? Now, what makes it non-inventory, right? Because if it doesn't fit within the scope of being inventory, it looks like, given what we said, right, that Kyle, Travis, that capital assets are very broadly defined. If it's not inventory, then it looks more like a capital asset. Everyone agree? So, women, men, why would you say your eggs are not inventory? What's the best argument that you have, Kyle? Right, inventory you can replenish. Women, can you replenish your eggs? No, so they don't have the same aroma as being inventory, right? They have a different feel to them. Now, when I told someone, when I wrote this paper about women's eggs, it was a good catch because I wanted to write about capital assets. So I used this as an example of a paper. And someone said to her, like, what did you do this summer? And I was talking to this woman many years ago and said, I was writing this paper. And she said, oh, coincidentally, she's a Harvard unemployed actress at the time. She was using her eggs to make extra money. So I said, oh, would you be interested in being a test case? Because I'm writing this paper and maybe you want to report it as capital gains. And she said, well, just to let you know, by the way, by way of background, are you women supposed to sell your eggs regularly? Yes or no? No, it's not healthy, right? Being put on these hormones is not something you want to do. So most infertility clinics will only take you once, to my knowledge. So it's not like you can come on a monthly basis and say, here's your supply of eggs. And in her case, though, she went to 3 or 4 different infertility clinics to supplement her income. And all of a sudden, is she the best test case when she had sold her eggs, I believe at that time, at least 3 times, I think possibly 4. She a good go-to case? No. So that was 10 years ago. So no case, to my knowledge, has been rendered on this issue. But so your answer, for our purposes, I don't know what the right answer is. Okay, but you can see how these things can make for interesting questions. So onward, capital asset, Maudlin. Okay, we have this Maudlin case. Carol Doyle, have you looked at this? Do you know what this case is about? Is that yes? No? Maybe? Carol, you have a chance? Carol? What happens here? Jared, did you? So what was he by background? Was that what he was doing, Carol?
Yeah.
Did he have a profession before selling lumber? He was a veterinarian. I mean, you might say that's an obscure fact, but in this case it may play a role in the outcome. So I'm not into obscurity, but I think it's important to know what his profession is. All right, so he's a veterinarian. And he's the equivalent of someone buying swampland in Missouri. He goes out and buys this land. And what does he do? What was his expectation of buying this land? Go ahead, Jared.
Kind of dual purpose. I think he was looking for lumber as well as to sell for real estate.
I mean, it looks like he was looking really as an investment, right? And he buys it in 1920. He tries to sell it several years later in 1924. Can't get rid of it. And there's a whole series of events where he's trying to it doesn't prove to be profitable until what happens? Does it become profitable? Does this land become more valuable? Yes. That somehow there's some sort of addition that's put on, some sort of road or something that allows this land to become accessible, and it becomes much more valuable, right? And in the meantime, he gets immersed in lumber, and in addition, even on his 1940 tax return, they ask him that the nature of his business is real estate. So all of a sudden, he goes from being a veterinarian into being immersed in the real estate world, right? Right? And what happens with respect to these pieces of land? What does he do with this land, Jared? All right, he subdivides this land and starts selling it, right? Everyone agree? And when he does that, what's the issue that the IRS has to address? But why? Who cares? Is what? Is what? Right. He starts selling, subdivides these pieces of land, starts selling this land, and recognizing, I'm making up numbers, the numbers are not important for our purposes, say $100,000 an acre, right? And the question is, excuse me, how does he treat that $100,000 on his tax return? As ordinary income or capital gain? Taxpayer would like to treat it as how? And the IRS says no. It's ordinary income. What is the IRS, the thrust of the IRS argument? That as a practical matter, this is inventory in his hands, okay? That even though originally, and this is on the top of page 734, admittedly, taxpayer originally purchased the property for purposes other than for sale in the ordinary course of business, right? That originally it was not designed to be inventory. But subsequently the taxpayer's philosophy or psychology changed, and as a result it was transformative, and it became such that the land became inventory in our taxpayers' hands, right? Right? So the fact that you buy it from one purpose does not mean or govern for the end purpose, okay? The fact that you buy something originally as a capital asset, in this case an investment, does not mean that's set in stone. That subsequently it can be transformed into inventory, and that's what happened here. Everyone get that? You buy something for one purpose, doesn't mean it's going to control at the end of the day. We have this Melton case on page 734. What's the purpose of this case? It's to look at Code Section 1221. And if you look at Code Section 1221A1, the last phrase says, or property held by the taxpayer primarily for sale to customers in the ordinary course of trade or business. Everyone see the word primarily? Everyone see it? Code Section 1221A1. And what was the role here of the U.S. Supreme Court? Well, just like burrito and sandwich had to be looked at, and what does the dictionary say? The word primarily had to be investigated, right, Matt?
That's right, and they found that it ended up in principle.
Yeah, it means principally. It does not mean, if you look at the second full paragraph on page 735, it does not mean primary if it is substantial. It's got to be principally, okay? So this case is an exercise in trying to figure out what a word means, and then the Supreme Court can remand it back to the lower court and say this is the appropriate test. right? So the important takeaway in this case is that the word primarily means principally. And what the authors do in the note that follows, it looks at several of the exceptions. I pointed out the three most important, but several other exceptions under Code Section 1221, right? Just take a look, if you could, at Code Section 1222. If you look at Code Section 1222, it has other terms relating to capital gains and losses. And it says that it means, if you look at these definitions, each one of these contain a term of art, sale or exchange, okay? If you look at all 11 of these, nestled in there is going to be implied or explicitly stated sale or exchange, right? That if there's no sale or exchange, for example, if you give a gift of appreciated property, does that trigger a recognition event? And the answer is no, right? There is no sale or exchange, right? So sometimes, though, things don't look like sale or exchanges. In this Keenan case on page 738, it refers to, by the way, just point this out. Again, I'm not a history person, but I just don't want people to get lost. If you look at the second full paragraph on page 739, it says, the board overruled. Do you remember from our first class, what is the board referred to? Do you remember that? And if you don't, that's okay. But I just want to, again, make sure if you look at these older cases, you know what the board is. The board is the BTA, Board of Tax Appeals. That's the predecessor to the U.S. Tax Court, okay? The predecessor. So when it refers to the board, it's referring to the predecessor. And what happened in this case? Someone was bequeathed $5 million. And the question the court had to address, and how did the trustees satisfy this bequest? They paid appreciated securities, right? So the securities, just to make up numbers here, had a tax basis of $1 million, fair market value of $5 million, right, Matt? And what happens here, Matt, when they use the appreciated securities to satisfy? They give the beneficiary the securities, right? They don't give the beneficiary cash. And what is the holding of this case?
The problem was that they didn't calculate gain because they waited.
Well, the taxpayer takes the position there's no gain or loss. And when I say the taxpayer here is the trustee, okay? Keep in mind, you don't have to look right now, there's Code Section 641 that I'm teaching this semester. It deals with what's called Subchapter J, the income taxation of trust and estates. And if you have a trust, just like you have a corporation, a trust is a separate taxpayer that has to file a Form 1041 each year, not a Form 1040, a 1041. And the question is, on this taxpayer, namely the trustees, do the trustees have to file and report this gain of $4 million on the Form 1041? And do you recall what happens here? They did not. They took the position that there was no sale or exchange. They were merely satisfying a specific bequest. Does the court say that's correct? Right, the court here says, no, that's not correct. That if you have to satisfy a debt with appreciated property, that's the equivalent as if the taxpayer here, namely the trust, sold the securities, got cash of $5 million, and used the cash proceeds to satisfy the debt. So the court here said this was the equivalent of a sale and ruled against the taxpayers and said that the satisfaction of a debt with appreciated property constitutes a sale or exchange. So that's a takeaway here. Just to make this more vivid, page 742, second full paragraph. There can be no doubt that from an accounting standpoint, the trustees realized a gain in the capital of their trust when they disposed of securities worth far more at the time of disposition than at the time of acquisition in order to settle a claim of $5 million. All right? So the author's point in including this, you get a visual that sometimes, even though there's no, what you might think is technically there's no sale or exchange, the courts may reconstrue something and say, gee, it's the equivalent of a sale or exchange. And we have this Hudson case, which when you guys, but the good news or bad news that this summer we're going to hopefully be together the second time around. But my point of saying that is that I'm a big believer of stick figures, all right, that particularly when it comes to corporate transactions for myself and the clients, to try to understand a transaction is to draw it very simply. So I don't know, did anyone have a chance to read this Hudson case and follow along what happened here? I heard someone say yes, but they didn't, and then they trailed off. What was the starting point, Liz, and then we can go from there. Okay, so we have MH had his judgment of $75,000 against HC, okay, right? We have this Mary, got a judgment against Howard Cole of about $75,000, right? And what happens to Mary? Hold on, what happens to Mary? That's critical here. Yep, good old Mary's not here anymore, okay? And what happens to the judgment? Yeah, Galvin Hudson buys it. Now, how much, do you remember what he buys it for? $11,000, okay? Now, why did he buy a $75,000 judgment for $11,000, guys? But why would anyone demand to sell a $75,000 judgment for $11,000?
If they just want cash, it's trust.
What do you know about people who owe you money, Doyle? The chances of collection are pretty slim when it comes to $75,000. It's not. Look, back in when this case was decided, that was real money. But still, this guy Howard Cole was probably a deadbeat, and the idea of getting money from him might have looked pretty dim. So you might say, look, I'd rather get 20 cents on the dollar than getting zero, right? So the estate sells this for $11,000. And what happens next? Yeah, Howard pays $21,000, right, to Galvin. Now, I'm not saying this is pretty, okay? No Picasso here. But, again, whether it be for yourself or your clients, guys, having a little figure like this can, I think, be very useful, particularly when we're dealing with corporate tax or when I teach partnership tax, is little diagrams go a long way, I think, to your comprehension, client's comprehension, supervisor's comprehension. So I would, in your margins, periodically, when it comes to hard-to-follow facts, Liz, draw little diagrams to try to help you follow. Because if you read along, it is, I think, Liz, pretty impenetrable. But if you draw a little stick diagram, it may get you where you want to be. All right? And again, if you're explaining deals to clients, and I'll say this during the summer too, I usually like to have 4 quadrants where I explain what is it before, like, I talked to you before about in a memo, you always try to put the facts first so that we're all talking about the same facts. Before the transaction itself, and then after, and then have a bunch of bullet points explaining sort of the salient parts of these graphics. All I'm saying is it's useful for clients, useful for you to make sure you get a complete picture of what's happening before, what is the transaction looking like, and after all the dust settles, what are you hoping to achieve? And then spelling out perhaps in bullet points. Now look, it may take 6 quadrants, I don't know, But I'm just telling you that if you're doing a transaction, it's not a bad idea to, again, make sure you have a before, during, and after so that people can follow what you're doing. So, Matt, Liz, what's the issue the court has to address? Is what? Right, Howard has to look at the different, and numerically, how much does this taxpayer have to report? Say again, because I know Emmanuel can't hear you. Is that what they have to report, Andy, 21,000? How much does the taxpayer, do you think, numerically has to report here, Justin?
I would say 10.
10, right? He gets 21, but he has a basis of 11, right? Everyone agree? No, it doesn't have to report 21, right? And the issue is, again, this part of the chapter, guys, is not a question of how much. It's a question of what is the character, right? What is the character of that income? And the taxpayer wants to take position as capital gain, but what does the court say? Say again? Why? Why? Go ahead, Joyce. Right. Court says, look, this was a matter of extinguishing a debt, right? Galvin Hudson did not give Howard Cole a thing, right? There was no sale or exchange. Everyone agree? He got $21,000 and the debt was extinguished, but there was no, what you would say conceptually, there was no exchange here. Everyone agree? If someone owes you money and they pay you money, is there a sale or exchange, or is that just the satisfaction of a debt? Satisfaction of a debt. Everyone agree? So the taxpayer loses here. Would the taxpayer lose today? Would the taxpayer lose this case today? Who says no? Joyce, you say no. Liz, you said no. Why not? Which is what? 1271, right, Liz? What does 1271 say? Say again? No, it doesn't say that, but 1271A says what? Can you read it for me, Liz? Arish. 1271A, A1. Keep going. Okay, and I know in your heart of hearts you were emphasizing with your tone the word exchange, right? Yeah. Thank you. Notice that word exchange there. And what Congress is doing is saying, treat the retirement of any debt as if there were an exchange. So why? That gets you to the promised land of Code Section 1222. So even though technically there's no sale or exchange, Congress, right, can write the rules. And here it is artificially treating any extinction of a debt as if there were an exchange. And this could be very useful for our clients because many times, for example, they don't have debts like this, right? Many of your clients are not going to buy these kind of obligations. But what are your clients potentially going to do? What are most of your clients going to do? 95% sometime during their life, for sure. They're going to buy bonds, right? Issued by municipalities and others, bonds, right? Those are debt obligations, right? And at some point, might those debt obligations be called for an amount larger than your clients paid for, right? So the city of Newark issues a debt obligation to your client, say, for $50,000. And it's at a fairly high interest rate, and Newark wants to call that obligation and pay you $52,000, right? How are you going to treat that $2,000 on your client's tax return? $2,000 capital gain, right? Because it's going to be treated as an exchange. So it can prove very useful because there are a lot of debt obligations out there. Right, so notice, guys, when Congress doesn't like the outcome of a case, it's at liberty to change it, right? And in this case, make it pro-taxpayer. I'm sorry?
Is the taxpayer allowed to go back at Congress?
No, because this law is not retroactive. It's only prospective after 1997. Okay, so it's not retroactive. Taxpayer can't amend. Taxpayer is stuck with the outcome. All right, so page 747. Creditor purchased an individual debtor's $5,000 interest-bearing note from a third party as an investment at a cost of $4,000. In 1996, several years later, debtor pays off the principal of the note using GM stock, which debtor purchased several years ago at a cost of $2,000, which is now worth $5,000. What are the tax consequences to creditor and debtor? Okay, creditor and debtor. So, in this case, we're going to have the debtor paying off using GM stock. Tim, Caitlin, Justin, you guys play the role of the debtor, and creditors here, Howard, Al, and Rachel, Raquel, you be the creditor. So debtors, did I do that right? You're using this. Any gain or loss to you guys? Do you agree? Caitlin, Justin? If you agree, then you need authority. Yeah, you would cite to the Keenan case, right? So in this case, when the debtor uses appreciated property to satisfy the obligation, there would be a gain here on the GM stock that would have to be recognized, right? Creditors, gain or loss here? If so, what amount? Howard? Al? Raquel? Matt? $1,000? Raquel? Agree? Disagree? NECA? Agree? Disagree? Amanda? Agree? Disagree? You agree? Mary, is that right? What's the gain here, if any? Say again, Nina? What's the character, Nina? Jenna, what's the character? We know it's income. We know it's 1,000. We need to know the character. David? Would that be right? Ying. Right? Ying. You sure? What year was this? When does, Liz, when does Code Section 1271A come into being? 1997. Oh no, so this would be $1,000 of ordinary income. Now I will not on an exam ask you a question like this, okay? I do not ask history questions. But be forewarned, I may not, but your client may, okay? Just be forewarned, seriously. And what I mean by that, in particular, for example, if you recall, Code Section 1015D6 usurped or took over Code Section 1015D1. And obviously, you would have a serious case of malpractice against you if you resorted to the wrong code section. So it's up to you. I'm not going to test you on that. When things came into effect. But on the other hand, that's a danger of practice. Is taking, for example, I know many of you are going to be very proud of your code books, and I don't blame you. But if you bring it to work and start relying upon it a year, 2, 3, 4 from now, you really do so at your own detriment, right? Because as the code changes, you got to change with it. And the worst thing there's many, I don't want to say the worst thing, there's a lot of bad things that go on out there. One of the bad things you can do is rely on old law to come to a conclusion. All right, holding periods. Okay. Shoot.
So it doesn't matter that it was settled, debt was settled after 97, when the actual exchange happened.
Let's just assume for now, let's assume the exchange, for our purposes, 1,000 of capital gain would work. I'm just pointing out Code Section 1271 really didn't come into being until after 1996, so we'd have an issue here. Holding periods. Remember, how do you get to the promised land of getting preferential rate treatment under Code Section 1H? What do you have to do? Hold it? No. You're wrong, but they're good being wrong, okay? I like the way, thank you, you're not as shrill in my audience. What do you have to really do, Mike? And this is critical. I heard you, someone whispering it? Who's whispering? How long do you have to hold it, Mike? Can you read the code? Just Code Section 1222. What does it say? 1222, I think it's 9 or 10 long-term capital gain. What does it say? Ah! Stop. Yeah, if you tell your client, just hold it for a year, and don't worry, you'll be sued. Just picture, if you will, you're typing an email to your client and just say, hold it for 1 year, and they hold it literally for 1 year and sell it based on your advice. Again, very bad day in the office if you do that, right? Now, we have a revenue ruling, 66-7 in our casebook, right? Now, in this case, BIN. What does it refer to if you looked at this revenue ruling 6 months? Recall? Chris? I'm sorry? Seva? Joe? Bill? What?
Didn't it used to be 6 months long-term capital gain?
Is that the answer? Yes, it used to be 6 months. So why are the authors in this book showing us this? Why, Jimmy, do they have it in the book? Jimmy, why is this revenue rolling here? If it's now not a year, because Mike would tell you it's not a year, it's more than 1 year, but why do they have this 6 month, this revenue rolling in this casebook if it seems woefully outdated, Jimmy? Jarrett? Right. I mean, the 6 months is irrelevant for these purposes. The most important takeaway is on page 748, the third full paragraph. In view of the foregoing, it is concluded that the holding period of a capital asset begins to run the day following. Okay, not the day you acquire it, the day following the acquisition of the asset involved. Okay, that's going to be critical. Okay, so even though the 6 month period is irrelevant, right, Jimmy? Doesn't matter. We don't. The revenue rolling has importance for other reasons. Agreed? What about the revenue rolling that follows, 66-97? What's the takeaway there? MJ. I'm sorry? Right, the trade date's the important date, not the settlement date, right? The trade date is what controls, not the settlement date. Okay, and in the material that follows, you guys, I'm leaving up to you. There's, in the note, talks about certain rules of thumb that people should know, including, for example, on page 750, the first full paragraph talks about that if you buy multiple blocks of stock, which block are you deemed to have sold? Is it a LIFO or FIFO system? FIFO. Okay, it's a FIFO system, right? First in, first out. All right? And they talk about other means, other protections Congress has put in to insulate taxpayers from playing games. All right, so I'll leave it up to you about reading how these apply. Look at page 752. Let's look at problem 1 before we take a break. You have taxpayer, cash method calendar year taxpayer engaged in the following transactions of stock. Consider the character T's gain or loss in each of the following transactions. Okay? A, T bought 100 shares of stock on January 15th of year 1 at a cost of $50 per share. T sold them on January 16th of year 2 at $60 per share. Okay? Everyone get that? What is T's basis in these shares? Martina, what is T's basis? Okay, but a total basis of how much? 5,000, right? What code section? 1012. Okay, and now if you sell them for $60 a share, what is the amount realized here?
1,000.
What's the amount realized?
5,000. No, wait, 4,000.
How much is the amount realized? You're under pressure.
Okay, 1,000.
Oh, the amount realized is how much, Carol?
6,000.
What's your authority? No, that's basis. Doyle? What? 10, no one's dead. No one's gift. Go ahead. 1001B. Amount realized is how much? 6,000, right? So, Martina, what is the gain or loss? Recognized, right?
Long-term gain of 1,000.
Don't get into character yet, but how much is recognized? 1,000, right? And is that recognized gain? And if so, what code section? 1001C, right? It says, unless otherwise provided in this subtitle, all realized gains shall be recognized, right? So we have 6,000 less 5,000. We have $1,000 gain, right? Get that right numerically. Now, what is the character of that $1,000, right? Because that's critical. We have the numerical correct answer. What kind of asset, Emmanuel, is this stock? How would you classify this? Forget about, I just want to know what is stock in this company. What kind of asset is that? Forget about gain, it's capital asset, you say. What's your authority? Jeffrey, what's his authority? John, what code section? What code section? 1221, right? It's capital asset. Everyone agree?
I thought you said stock falls under inventory.
No. Read the definition of stock. That's stock used in a trade or business. It doesn't mean stock. It doesn't mean common stock, right? It doesn't mean this intangible asset, right? So this stock is in a company is your traditional capital asset if there ever were one, right? So we have $1,000 capital gain, right? Now, the tough question, but the one that Arish is going to handle, is this long-term or short-term, right, Arish? Arish. I can't say it right.
If it's short-term or long-term.
How do I? It's two syllables, right?
R.
R.
Air. R.
R.
Ash.
Okay, I think I'm going to get it now. I think. It only took me a month, but R. Ash.
R. Ash. There you go.
R. Ash.
Pretend the first A's not there.
I got to pretend. And it's just a long R, right?
Yeah. Don't say it too long.
All right. Don't say that. Arish. I'm doing all right?
R. Ash.
Arish.
So, is it short-term or long-term?
Yeah.
Um,
And Liz, what?
long-term.
And do you agree? Liz? Doyle? Carol? And if you say yes, Carol, you can't be that quick. Tell us why. Okay, so what's your starting period? And when did they buy the stock? So when does the holding period start? When does the holding period start? So, Carol, what do you say? Doyle, you agree?
It's more than a year, yes, so be sure.
Since you started this conversation, Martina, what do you say? You stick with long term. So you're denying your neighbors here, right? Okay, Jared, Doug, Mike, short term, Jared? Good. Let me just ask you a question. How many of you celebrate a birthday annually? I think we all do. All right. Now, when you have your birthday, you generally would, even though you might not say this, you think this, you are 1 year older, right? So if you were born on January 16th, okay, and the next year comes along, are you more than 1 year older? No, are you more than 1 year? No. Once the clock hits 12:05, assuming that you were born at 11:59 on July 16th, and now it's July 16th, January 16th of the next year. Last I checked, guys, that's more than 1 year. January 16th to January 16th is more than 1 year. Think about it. If you go from January 16th to January 15th, that's exactly 1 year, right? That's 365 days. And if you go, all right, I like that enthusiasm, Arish. That is it, right? More than 1 year, long-term capital gain, right? So Martina stuck to her guns and was right? You guys all stuck to your guns. Those who stuck to their guns were successful. Question B. T bought 100 shares of stock on February 28th, year one, at a cost of $50 per share, okay, and sold them. It's obviously leap year on February 29th of year two for $60. No, numerically. Ran, gain or loss? Gain of how much? How much? 1,000, right? And shooting? You agree, but is it long-term or short-term? Long-term? Patty, agree? How? Everybody long-term? Sierra, Joyce, you guys long-term or short-term? I hear short-term and long-term. Okay, Pretty's going to give us the final answer. Her life rests on it.
I guess it's a short term.
You're dead.
No.
So, actually, is it? No. Is it? No, I'm only joking. No. When does it start, actually? When does the holding period start? March 1st till when? When does it start? March 1st. Everyone agree? And when does it end? February 29th. It's a leap year, right? That's exactly, and Pretty, I stand corrected. I got over in Bunctious. You're well above ground because it is exactly 1 year, right? March 1st to February 29th, right, is exactly 1 year. Sure, you're happy you got that right? You did? I thought you were going to give me that you were right. It's exactly 1 year. It is short-term capital gain. Yes? All right, that's what I want to hear. Short-term capital gain. All right, everyone agree? So for your notes, you have it. It's not good enough just numerically to have the right answer. You must have, again, what is the character, long-term or short-term, right? Question C. T bought 100 shares at $50 on February 10th, year one, another 100 shares, so they buy two different blocks, one in February, one in March. T sold 100 shares on February 15th of year two at 60. We know numerically, gain or loss here, guys. Gain of how much? 1,000. Long-term or short-term? Long-term. What's your authority? What's your authority that you can use the first block? Martina, I heard you say it. Okay, where do you find that? Where do you find it? It's not, go ahead, MJ. Okay, the regulation, 1012-1C1, 2 little I, that the authors cite you to, right? Okay, that regulation stands for the proposition first in, first out. It's not the revenue ruling, guys. And it's not the statute. You need the help of the regulation here. All right. Why don't we do this, guys? Let's take our usual 7-8 minute break, come back, and we'll start here, okay? Got a lot to cover today.
Previously was, it says 1,500 in case of married individual.
Was 1,000 long-term capital gain. Question B was 1,000 short-term capital gain. Question C, 1,000 long-term capital gain. And question D, that's where we left off. So we're going to pick up here with question D. Question D. T sold T's broker, or told T's broker to purchase 100 shares of stock on December 29th of year 1 at a time when its price was $50 per share. The stock was delivered to T on January 3rd of year 2 when it's selling for $52 per share. T told T's broker to sell the stock on December 30th of year 2 when it sold for $60 per share. It was delivered to buyer on January 4th of year 3 when it's selling for $63 per share. Okay, what is the tax basis we have, Wei Jin? What is the tax basis here to the taxpayer? How much? 1,500. Ben, do you agree?
Yeah,
How'd you get it numerically?
because it's short term.
Forget about short term. How many shares were bought here and at how much per share? How many shares were, Wei Jin, how many shares were purchased? 100 shares at how much per share? 50, which is how much basis? 5,000, right? 5,000. What's our authority? What code section? 1012. Everyone agree? Code section 1012. Now, if you buy it for $5,000 and subsequently you sell it, and Joyce, what do you sell it for? Sell it for $6,000, right? Why do you say $6,000? Because you sold it for $60 per share. How many shares? 100. So that's $6,000. Gain or loss here? Gain of how much? 1,000. And it's just short-term, long-term, Patty? Patty? Ran, you agree? Definitely. And how? If that's true, what's the authority for that? What are we going to rely on? Revenue ruling what? Say it louder. 6697, right? The important date here is the trade date, not the settlement dates, right? Question D, same as above, except that the value of the stock on December 30th, and we said it was long-term. Why? When does the holding period start? Sierra? Got you swallowing. No. Larry, when does the holding period start? Give me, what is the date then? What day? December 30th, right? And they sold it when? When is it deemed to have been sold? So is that more than 1 year? Yes, it's more than 1 year. December 30th to December 30th is more than 1 year, right? Question E. Same as D, except that the value of the stock on December 30th of year 2 was $45 per share, and on January 4th it was $48. So, in this case, MJ, any gain or loss? How did you get it? What was the amount realized? 45, and what was the basis here? It was 5,000, right? 5,000, you sold it for 4,500, right? Matt, what do we need for a loss to end up on your tax return? What do you need to get to the promised land, Mike? What do you need? Raquel, you were saying?
Has to be a capital loss.
It has to be what?
Capital loss.
Well, is this a capital loss, guys? Is this a capital loss? It is a capital loss, right? But even before we get to, what do you need for losses in general? Allowed, right? They must be realized, recognized, and allowed. What code section opens the door for allowance? What code section? 165, right? Right? You need 3 fingers up. Realized, recognized, and allowed. Is this loss allowed? It's in entirety? So how much is allowed? Well, how much is the total loss here? $500, right? So would the whole loss be allowed here? Yes. What would be the authority? Code section 1211, right? The limitation does not come into play, right? So code section 1211, we don't have the loss would not be limited here. What about question F? T's father bought 100 shares of stock on January 10th of year 1 at $30 per share. On March 10th of year 1, they were worth 40. He gave them to T. Okay? So in this case, when T gets the shares, Jimmy, is that taxable when T gets the shares? I just want to know, is the receipt of those shares taxable? If so, what's your authority? What's the authority here? Bill, what's the authority?
As a gift?
Well, you're right. It's a taxable income.
No,
Joe?
It's a gift.
It's a gift? Joe, is it exempt or not?
I'm going to say it's exempt because it's a gift, I guess.
Under what? You can't just not, this can't be just Joe's rule. There's got to come from a source. Gary?
1015.
That's basis. Can't cite to code section 1015, right? Seva?
I was going to say 1015B, but...
Stefan? So again, same again? 102A, right? Guys, don't lose your bearing, right? On an exam, I'm not going to telegraph the question, and even though we're talking about gains and losses here, don't forget everything else you learn, right? 102A. Right, Jimmy? It's exempt under 102A. Okay? But that's not the issue that the client's raising. He gave them to T when the stock, who sold them on January 15th, a few months later, for $60 per share. So what is the T's basis, David, in these shares? And what's your authority? Justin, what's his authority? Jenna? Would that be right here, Nina? Nina, what is it? There's no 1223 here. Amira? Amanda? No, I'm talking about basis. Now you're stating to 102A. That's a concept of not income. Bin? 1015A, right, guys? For the proposition, it's a carryover basis, right? And now the shares are sold, right? You hear the word sale. What code section, Howard, comes into play? You hear the word sale. What code section, Howard? How? What code section? Ben? No, you hear the word sale. Martina? 6697. Why do you think that? I'm talking just generally. You hear the word sale or exchange. What code section comes into play? Don't overthink this, Kevin. What code section? You hear the word sale or exchange. What code section? Toil. What? That gets into the issue of character. I just want a simple answer. 1001. Guys, 1001. I said sale or exchange. What code section? 1001, right? I didn't ask basis. I just said there was a sale or exchange, right? Code section 1001. We had to comes into play, right? Joe?
Was T liable at 60?
I don't know what you mean by liable at 60.
Or F? Like was the number, I know it was 1015, but was the number 60?
I don't know what you mean liable at.
Like, was he taxable at $60 per share?
What? Okay. He sells the shares, right? Everyone agree he sells the shares. What's his amount realized here? 6,000, right? Everyone agree? No controversy, right? What's his basis in the shares? 3,000. Gain or loss here? Gain. We're all good. I like this chorus here. Now, right, is it a capital asset? Yes or no? Is this a capital asset, Mike? Yeah. No controversy. Everyone agree? Right? No controversy here, right? Because even though, right, Sierra, it's stock, it's not stock in the traditional sense, or that's not inventory, right? This is a capital asset, right? Now, the real question the authors are addressing, now we got through all that stuff, right, Jing? We got to know, is this long-term or short-term? Shangnan, you see if you agree or not. Shangnan, you say short-term. John? You thought it was long-term? Do you have authority for that? You can't just say it is because it is. Okay? What? Why do you say it's long-term, Zhao? 1223 what? Oh, 1223-2. What is 1223 entitled? Well, that might be a good place to look. And the authors also tell you to look there. Boy, that's 2 for 2. And it says, in determining the period the taxpayer held property, however required, that should be included in the period which such property was held by any other person if in this chapter such property has for purposes of determining gain or loss from the sale or exchange the same basis in whole or in part. So what you're saying, right, so that is under code section 1015, right, there is the same basis, right? So that applies, that triggers the application of code section 1223, right, 1223. And then what is the holding period to T here? When does T's holding period begin? It's whenever the father acquired the property, right? So the father's holding period started when? January 11th, right, really. It's the day after you acquire stock. So is the long-term or short-term? Long-term. Everyone agree? See, these make for great multiple choice questions, right? And everyone here can nail these. And these questions come up all the time in practice. This is not just the authors having fun and move on from there. Question G. T's father purchased 1,000 shares of stock for $10 per share several years ago. The stock was worth $50 on March 1st of year 1, the date of father's death. The stock was distributed to T by the executor of the estate January 5th of year 2, so several months later it was distributed, and T sold it for $60 per share. So he bought it for 10. First of all, Jimmy, when the son gets this inheritance, any income to the son? Jimmy? No? What's your authority? Come on, Jimmy. We just did this. 102. Don't say it with a question mark at the end. If I'm at the cocktail party and you're trying to get me as a client, you in with a question mark? I'm moving on to the next person. All right? 102A, it's not income, right? But that's not the issue. What is the basis here to the recipient? What is the tax basis here? Jing Jing?
Fair market value,
So give me a number.
50,000.
What's 50 times 1,000?
What? 50 times, yeah.
Okay.
Oh, 5,000.
5,000, right? 50,000. It's a long day. 50,000. 50,000. Okay? And then it's subsequently sold, right? For how much? 60. And we hear the word sale or exchange. What code section do we think about? 1001, right? Everyone got that? You're just going through, you hear these words, and you're thinking code sections, right? So you hear sale or exchange, you're thinking 1001. You think the amount realized here is 60,000, basis of 50,000. Gain or loss? Gain of how much? Okay. So given this, Igor, long-term or short-term? And Kyle, see if you agree.
Long-term.
Travis? Kyle, agree? And if you say yes, Kyle, Travis, what's your authority? What does 1223.9 say? Travis, what does it say? What does that code section say with respect to holding periods? What does 1223.9 say? It's always deemed to be long-term. So someone dies, bequeaths you property, you could sell it the next day. And guess what your treatment is? In other words, even if your father or mother bought stock last week, and sadly the next week, the following week, they die, and they bequeath it to you, and you subsequently sell it at a gain, even though the time interval might only be 3 weeks, guess what? You command long-term capital gain treatment. Why? Code section 1223.9. All right? Everyone get it? Congress has the right, at any point it wishes to transform, just as we saw with Code section 1271, where Congress reversed the Hudson Case. Congress, too, is at liberty, if it wants to treat something that it thinks, for whatever reason, in this case, considering it tries to be friendly at death to taxpayers, the recipient of this kind of property, accords long-term capital gain treatment. Again, question, if we got rid of capital gains and ordinary income distinctions, think about all the code sections that might disappear if there was no distinctions between that kind of income. That the girth of the code could probably be reduced in half. And just, again, think to yourself, is it justified to reduce, is the preferential rate justified? Does it really spur the economy? Okay. Question H. Same as G above, except that T was the executor of T's father's estate, and as such, T sold the stock on January 15th of year 2 for $60 per share to pay the estate's administration expenses. And once again here, sale or exchange, 60,000, basis here of 50,000, and whomever sells whoever is the recipient of the father's stock here will get the long-term holding period. So your answer to question G and H, the outcome is the same. It doesn't matter. All right, so for your notes, both of those answers, because of the authority of Code Section 1223(9), would be long-term in both instances. Question 2. Owner owned 4 acres of urban land which she leased to Tacker for 99 years at agreed rental of $10,000 per year. In addition, Tacker acquired an option under which she or her assignee could purchase the property at any time during the life of the lease for $250,000. Tacker being permitted upon the exercise of the option to apply against the purchase price $1,000 of prior rent for each year the rental payments had been made under the lease. 25 years later, in the current year, purchaser appeared ready, willing, and able to buy the property for $300,000. So someone's on scene to buy the property. Okay. And the question is, if she exercised the option and immediately sells to purchaser for $300,000, what are the tax consequences? So in this particular case, Shoeing, did I say that right? Shootling? What's the amount realized? $300,000, right? What's her tax basis here? Shoeing? How do I pronounce it? I don't want to, it's shooting? How do I, shootling? Shooting. Okay. The basis here is probably $250,000, what she paid for the property. I'm just putting in parenthetical. It's not that important. I'm going to assume that each year she deducted the full $10,000. All right? Let me just add that. If she and that she actually made a cash outlay of $250,000 to acquire this. So any gain or loss here? Gain of how much? $50,000 under what's the gain computed under Code Section 1001, right? 300 amount realized, basis of 250, gain of 50. Okay? Is this a capital asset? This land, Patty? Why? Doug? Well, forget about, where do you look for it, whether it's a capital asset, Patty? What code section? Say again, Patty? 1221, right? 1221. And what kind of asset would we say this is? Probably a capital asset, right? Doesn't fall within the scope of any of the exceptions, right? Doesn't look like it. We don't know, but nothing indicates here that it would fall within the scope of any of the exceptions. So, long-term or short-term? Ran. Long-term or short-term? Say again? I can't hear you. I'm sure no one on that side can hear you. Short-term. How? Do you agree? Why do you say short-term? What do you guys say short-term? Jarrett, would that be right? Matt, would that be right? How long did she own title to the property? Doug? Mike? Short term, Mike, agree? Yeah, she held the title to the property for like a day, right? She exercised the option, title was in the taxpayer's name for like a day, and then she sold the land, right? So she has short-term capital gain here. Suppose she sells purchaser her option for $75,000. Okay, sells it for $75,000. Caitlin, what's the amount realized? Hold on, let's start with the amount realized. The amount realized is 75, right? And let's just assume for the moment here, and for our purposes, that every year she paid $10,000 rent, she only deducted $9,000, because if you look at this problem, each year it says that she could use $1,000 of each rental payment to reduce the amount towards $250. So if she rented it for $250,000, right? Or excuse me, the purchase price $250. In theory, if she deducted only $9,000 a year, she would have a $25,000 basis. Follow the logic. If each year she was paying out of pocket $10,000, but she only deducted $9,000, right? Because each year she was using $1,000 to build up her basis in the option. If she sold it for $75, that's her amount realized under Code Section 1001. Her basis is $25. Gain or loss of $50. Long-term or short-term? In this case, it would be long-term, right? Because in contrast, how many years did she hold this piece of paper called the option? 25 years. And what kind of asset is it? It's a capital asset, right? Look under the definition under Code Section 1221. It doesn't fit within the scope of any of the exceptions. And here, notice how useful you as the tax practitioner could be here. You would advise your client, look, don't exercise your option. Sell your option. It's an assignable option. Sell your option. Command long-term capital gain treatment, right? And let the assignee exercise the option, right? So the author's point in presenting this second problem, the contrast between A and B, is not, again, the numerical difference. In theory, the numerical outcome could be the same, but if you're savvy about it with your client, you could command long-term treatment rather than short-term treatment, all right? Again, notice the distinction. In Part A, the taxpayer is deemed to hold title to the property for like a day. In Part B of the problem, the taxpayer is deemed to hold the option for 25 years, a quarter of a century, commanding long-term capital gain treatment. Shengnan, you got that? You got that puzzled look? Okay. If you agree in question A, if you exercise the option and you actually get title, that title is going to be recorded in the county in which you live or where the property is located. And you're going to have your name on that title for all of one day, and you're going to sell the land, right? So that's short term because you only held title for a day. In contrast, if you own this piece of paper called an option, not a deed, and you hold that piece of paper in your drawer for 25 years, and you sell the option, how long have you had that yellowish piece of paper now? It's now yellowed by the time. You've held it for 25 years. So that's why you're going to get long-term treatment. Okay? Justin?
What would the basis be under problem B?
Same, 25,000. I would argue 20, assuming you only deducted 9,000 each year. Question 3. T purchased unimproved land on April 1st of year 1 and commenced construction of a vacation residence, which was complete on January 2nd of year 3. Before T even moved in, and on that date, B offered $600,000 for the house and land. T's basis in the land is $200,000, and for the house is $300,000, and the proposed purchase price is allocable $250 for the land, $350 for the house. It can be established construction of the house was 50% complete on January 1st of year 2. What would be the tax consequences to T if the sale is effectuated January 2nd of year 3? So you got lots of dates and your head is spinning, right? Everyone agree? So Jen is saying, let's make a diagram. I don't know if you, and we will get to a diagram in a second, but we're told certain facts here that you have to be aware of. All right? What does it say about fair market value and adjusted basis? And again, I have this in my margins. We have land and we have the building. Everyone agree? And what do the authors tell us about in this problem about the fair market value of the land and building? No, I think it said, well, the basis is 200,000. Make sure you fill in the right quadrant with the right number. What's its fair market value? Building? Basis? And we know both are sold. Everyone agree? Everyone agree? So, you know what, again, let me emphasize, for exam purposes, for client purposes, it's never a bad idea numerically to nail the numbers, right? Everyone agree? Nail the numbers right. David, Ron, what kind of asset is your house? What kind of asset? Ron, what do you say it is? You told me to come back to you, Ron. I'm back. I'm saying what? If you say it's capital, what's your authority? 1221? Okay. John, would you agree? What? Say again? Why not? Does that have anything to do with the price of tea in China? I mean, the fact that how long it's held does not dictate the nature of the asset, right, Jeffrey? Where do you look, Jeffrey? Jeffrey, where do you look? Emmanuel, where do you look? Matt, where do you look? 1221. Matt, is it a capital asset or non-capital asset, Matt?
I think it is a capital asset.
I'm talking upstairs, Matt, but... Matt, is it a capital asset? You got to know this by now. Go ahead, Mara. Well, where do you see that in the code? Where are you looking in the code, Mary, where you see that? Nina? Arish?
What?
What kind of asset is your home?
It's not a capital asset, apparently, right?
I'm asking you. Don't tell me apparently. I'm asking.
I don't know.
Stefan? Capital. Are you sure? And you'd be right. 1221 doesn't fit within the scope of any of the exceptions, right? Right, Ron? You looked at 1221. It doesn't fit within the scope. It's definitely a capital asset, right? So numerically, guys, we got the numerical part right. Everyone agree? The authors gave it this, and we know it's code section 1001 applies, right? And now we have to figure out, and we know it's a capital asset, right? We're on a roll. And now we can, put it to rest. You ready to put it to rest, Liz? Long-term or short-term, Liz? You say that with equivocation. Carol, you're whispering? Ooh, that's creative. And you know what? You'd be right. And that's what that case says. And you know why? Let's think about it. Let's look at the dates. And here, getting back to Jenna's point, a visual might be useful. All right? And let me apologize by my artwork in a second. But it says, if you're reading along, it says that the person purchased unimproved land on January 1st of year 1 and commenced construction on the vacation house, which was complete on January 2nd of year 3. Okay? Before T even moved on, moved in, we got these numerical numbers. But it can be established that the construction of the house was 50% complete on January 1st of year 2. Okay? So if you can get the visual, this is, let's picture a 2-story house. Okay? And on 1-1-1-2, the house, the first floor is complete. Okay? Everyone agree? That first floor is done. Okay? And then the second floor, and it says, what are the tax consequences T if the sale is effectuated January 2nd of year 3? Well, during year 2, this is all being worked on, right? The second floor, right? There's this whole floor. And when it's, the property is ultimately sold on 1-1-3, how long has this second floor been around? 1 year or less. Everyone agree? This floor has been around for more than 1 year, but this floor is still a work in process during the entire year. Everyone agree? And Carol, how long have they held the land? Absolutely more than 1 year. So this is going to be all long-term capital gain, right? And we're going to split the baby. I know that sounds kind of terrible, but the judge said, look, let's split this because half the house was done, half wasn't. Half was held for more than 1 year, half wasn't, and we'll split 25-25. And you say, gee, that seems like justice. That's what the court did. And there's an actual court case very similar to that. Not identically, but similar. All right? Do you get that? Does anyone not get that? Again, you got to use a little visual here. I apologize for my non-Picasso here, but consider it Monet, an impressionist kind of approach. All right. Ready to move on? All right. Judicial gloss on the statute. Remember, in terms of authority, authority comes in many flavors, and sometimes we see the statutory form, sometimes regulations, and sometimes courts are going to put their own hues, H-U-E, hues, colors, right, to the statute, gloss here. And we have this Hort case. It's an interesting case. This is not a hard case to read, in my opinion. So, I don't know. Amanda, can I pick on you? Yes. I can? All right. That's what I'd like to hear. What happens in the Hort case?
Well, there was a lease that $25,000 and canceled.
Just say it a little bit louder. I'm not convinced Kevin can hear you.
There was a lease that was canceled, and instead of going through $25,000 a year, the leasee paid a bulk payment to...
Okay, so let me just pause. I'm leasing property to you, Amanda, and you're paying money. You're the lessee. So what happens? You just do the visual. You don't want this property, but I'm not going to let you off that easy, right?
No, so I have to pay you, I think it was $140,000.
So Amanda's going to pay me off because she's locked into this lease, and to let her go from the lease, I'm going to demand some money, right? And Amanda, what was the dollar amount? It's not that relevant here, but 140, 120? Was it 140? I don't remember specifically. Okay, 140. You pay me 140, and Amanda, what do I do for tax reporting purposes when I get that money? I didn't? What did I do instead?
You reported a loss.
What?
I know.
Why would I report this as a loss?
Because it was the loss that you thought you incurred from the lease being canceled.
Oh, you mean, had you stayed on that property for X number of years, you may have paid me, say, 160, and I only got 140. So to me, I suffered a loss of 20. Okay. Do you like my position, Amanda? What do you think I'm doing? What might you call me? Well, Try to keep it clean.
You're trying to avoid your tax liability.
Yeah, and I sound like a, excuse my language, scum. I hope no one heard me say that, but I mean, the reality is here I'm getting $140,000 and I'm going to take a $20,000 loss. Is there no justice in this world? Okay, Amanda, is the court receptive to that?
The commissioner said that the $140,000 that I paid you was gross income, or should be gross income, and the loss isn't allowed.
And who prevails?
The field Cooper and Supreme Court said that they cannot deduct the loss from gross income.
Okay. The court says, hey, this is the equivalent of an accretion to wealth, tax blunder, what code section? Amanda, don't look, just 61, right? Accretion. Now, could this be a capital gain? Isn't that the taxpayer's second argument that, okay, if it is income, it's capital gain? Does it constitute a capital gain?
No, I'm just wondering.
Why? You can't just say because you say so. MJ has her hand up.
Was a payment for cancellation, not for return income.
Right, this is a payment as a rent substitute, right? When you gave me money, it's really substituting for future rent payments, right? There was no sale or exchange of actual underlying property, right? So we don't meet the definition for preferential long-term capital gain, right? So I get stuck with all ordinary income. Justice is served here. All right? Not a hard case to follow, to the contrary. Fairly easy, but it sets the tone for cases to follow. All right, everyone got Horde v. Commissioner? It's a well-known Supreme Court case that a substitute for ordinary income, you can't transform it into something that it isn't, will ultimately result in the taxpayer having capital gain income. Metropolitan Building Company v. Commissioner. I don't know. Someone else here want to, if you have a stick diagram or diagram. Tamara, did you look at this?
No, I don't have a stick diagram.
But do you recall what happened here, even if you don't have your stick diagram? Nina?
It was the case where a leasing decided that he wanted to buy out his lease.
Okay, so who are the players? We have University of Washington, right? University of Washington, what role does it play? What role does University of Washington play here, guys? Say again? They own the underlying real estate, right? University of Washington owns the real estate, and what does it do? It executed the lease to whom? Right, it executes a lease to Metropolitan Building. So it leases the property to Metropolitan Building, and what does Metropolitan Building do? They sublease the property to whom? Olympic Hotels, right? So there's a sublease here. Oops, I don't know why I put SB, but SL, sublease. Okay, everyone got that? And that's all. Now, again, is this a Picasso, Renoir? You know, pick your favorite artist. It doesn't measure up. But at least you get a visual very quickly of the three salient players. So again, when you're reading these cases, guys, it doesn't hurt to write in the margins or in your notes just some stick diagrams to try to follow who the players are. So what is the objective here? Doesn't Olympic want to lease directly from Washington, wants to get rid of this Metropolitan, right? So what's proposed here? To get rid of Metropolitan is Metropolitan's going to sell. It's going to sell to University of Washington back to the landlord its leasehold interest in this property. Now, let's pause for a moment. I forget. Do you guys did you have legal environment? You're having it right now, right? No? Don't you have? When do you have legal environment? What? Business law. When do you have business law? Now, what's a leasehold interest called? Is it leasehold interest? What do you know about property? It's a bundle of rights, right? Everyone agree that when you own property that's fee simple, that's outright ownership, but a lease is like if property consists of 100 sticks, that a lease is, say, 5 of those sticks, or depending on the length of the lease, 90 of those sticks. It's a leasehold interest is an intangible piece of property, right? Everyone agree? So getting back to these lease arrangements, Metropolitan is selling its leasehold interest back to the original owner. And the question is, when Metropolitan sells its leasehold interest to University of Washington, the question is whether or not it should command capital gain treatment or ordinary income treatment. Okay, when Metropolitan sells its leasehold interest. And here I'll just point out to you on page 757, the first full paragraph in the middle says the tax court affirmed the ruling of the commissioner, meaning the IRS one. Metropolitan has petitioned the court for review, contending the payment in question should be held as capital gain. Okay, so here the appeals court ruled in the taxpayer's favor. So there's and we have concluded the petitioner is correct in his contention that the judgment of the tax court must be reversed. So here, the Ninth Circuit is reversing the tax court. Why? The IRS is saying that Hort should control here. On page 758, the third full paragraph, the commissioner contends the payment is taxable to Metropolitan as ordinary income. He relies upon Hort. If you go to the last incomplete paragraph, however, at the bottom of the page, the third sentence, again, on page 758, the third sentence on that last incomplete paragraph. The case is not, however, one of a liquidation of a right to future income as in Hort, right? That's the liquidation of a future right, but rather one of a disposition of income-producing property itself, meaning the leasehold interest is a real property interest. The leasehold property is a legitimate property interest that's being sold. It's an intangible property interest. And the fact that something is intangible, does that make it a capital or non-capital asset? It depends. In this case, it's an intangible interest that does not fall in the scope of any of the exceptions specified in Code Section 1221. It is therefore a capital asset. So here we have the sale or disposition of a leasehold property interest will give rise to capital treatment. And it was held long-term, so it will give rise to long-term capital gain treatment. So the sale or disposition here of a capital asset will give rise to long-term capital gain. This was somewhat perplexing, but if you look at Code Section 1241, what does it say? You have your code open? 1241. Right. 1241, amounts received by lessee for the cancellation of a lease, and we'll skip that next part, shall be considered as amounts received in exchange for such lease. In other words, if someone cancels the lease, the money they receive under the authority, now there's a code section. 1241 did not exist at the time Metropolitan was being rendered. is going to be treated as the sale or exchange. In this case, it's capital asset. I again refer you to page 756 this time. Look at how the issue is framed. 756, the second paragraph at the very bottom of the page. The question presented is whether the sum so paid to the lessee, okay, the lessee here is Metropolitan, is to be regarded entirely as the equivalent of rent owed to the lessee and taxable to the lessee as income. Okay, that's hort. Should it be treated like hort? Or whether it is to be regarded as entirely as the sale by the lessee, that's Metropolitan Building, of a capital asset and taxable as capital gain, which is ultimately how the court ruled. So here we have a court decision followed by Congress making sure here the taxpayer prevailed, unlike Galvin Hudson, and here Congress took initiative to say, even though the taxpayer won, we want to give clarity to the law, so we're going to pass Code Section 1241. So on a going forward basis, anytime a lessee's lease is canceled ahead of time, it's going to be treated as if there were a sale or exchange. So if your landlord wants to buy you out of a lease, how are you going to treat it if there's a sale? How are you going to treat it? If they buy you out of the lease, you're going to treat it as the sale or disposition of a capital asset. What's my authority? Code Section 1241. Now, I could rely on Metropolitan Building, but remember, we're in the Third Circuit, right, guys? We're not in the Ninth Circuit. So if I'm advising a client, my client might say, gee, are you sure it's good law in the Third Circuit? And I would have to respond, no, I'm not so sure. But now with Code Section 1241, I can reply in confidence and say, you would prevail, right? Because now we have a code section directly on point. All right? Now, continuing on. In the note that follows, on page 759, in the note that follows, the authors go through an exercise that you might need some assistance with. What do I mean you'll need some assistance with? Let me give you an example, and then, because when I say assistance, because there's some problems that borrow from the facts of the note here. Let's suppose husband dies and sets up a trust with $1 million for the benefit of the wife, his wife, and on the wife's demise, it flows to daughter, okay? So everyone had the visual. Husband dies, bequeaths $1 million in trust for the benefit of his wife. Then upon her demise, the asset flows, or what's in the trust, flows to the son, okay? What is the wife referred to vis-a-vis the trust? She's the lifetime beneficiary, right? And what is the son referred to as? The remainder beneficiary, right? Okay, so just very common in estate planning on the death of the first spouse to have these kind of trusts in place for the surviving spouse. Why are they set up for the surviving spouse? Say again, Kyle? No, you're more worried, Kyle, not about the state of New Jersey taking care of your wife. You're more worried about the tennis pro taking your money, okay, upon your demise. Right, Kyle? You want to make sure that this money ends up ultimately with your daughter, not the tennis pro, right? So you're going to lock it in trust, right? So many times, particularly in a second or third marriage, you want to make sure that your second or third or fourth wife doesn't take your money and leave it to his or her children, right? So, or a first marriage. I mean, I'm being a little bit facetious, but not that facetious. You are concerned, and particularly, and I'll say more so with the women should be concerned about their husbands, because my experience is if the women predecease the men, for us men, there's probably 8 to 1 women available because women live longer than men. So if we happen to survive our spouse, and then we do some really dumb things, us men. So if you women were smart, you'd set up trust for us too, because again, there's a real risk, particularly not just with respect to the tennis pro, but the real issue comes up not with the tennis pro most times. Except now Arnold Schwarzenegger new book came out. You got to worry about the housekeeper, right? But what do you really have to worry about? What happens most times? It's the caregiver, whether it be the husband or wife. The surviving spouse lives, but now the husband needs full-time help. Within a year or two, the person staying with him has convinced the husband she's the one who cares, and that even though they're not married, that your children don't care and leave everything to me. So it gets to be very, very murky. So many times trusts are set up. I'm just pointing this as a reality. And there's something called the uniform basis rules that your textbook refers to on page 760 and 761. In other words, picture, if you will, the husband dies, say, just to give a real contrast here, at age 30. And the wife has a lifetime income interest, and then it flows to the son. Okay? Or contrast that with the wife dies at age 80. Okay? What is under the uniform basis rules, what is in the first scenario, scenario 1, husband dies at age 30, and let's say the husband and wife are the same age, what do you think her actuarial interest is in the trust at age 30, and let's say she dies at age 80? What is her actuarial income interest? And we don't have to be rocket scientists. If the husband dies at age 30 and she's 30, her actual interest is probably going to be like 90%, right? Everyone agree? Where, by way of contrast, if she dies at or the husband dies, excuse me, at age 80, her actual interest is going to be something like 10%, right? Because she's much closer to death at age 80 than she is at age 30, right? So actuarially, her interest in that trust is much less, and the son's remainder interest, right, is much larger in that case. Everyone agree? Everyone see the flip? And obviously, along a continuum, every year the wife gets older, her interest actuarially becomes smaller, and every year the son's interest becomes larger because his mother's closer to death, right? That's a reality. And under something called the uniform basis rules, the mother's basis starts out larger, and over time gets smaller, and the son's basis starts out small and actuarially gets larger, all right? So keep that in mind as you're reading pages 760 and 761, because when we get to the problems next week dealing with this, it deals with that issue of the uniform basis. So I just want to highlight that so you have a better understanding of what's going on. And I just highlighted in yellow, this is up to you, on page 760 in italics they have measurement of gain, okay, how to measure the gain, so you should read that. And on page 761, again, in italics, I highlighted the character of the gain. Because why? What do we do throughout most of this chapter? We look at how much is the gain, and then what is the character of the gain. All right? So they go through that same exercise. And so, again, guys, when we get to the problems, in particular problem 4 on page 766, you'll need to know that. Okay? But we won't get to that yet, so just hold off. On page 762, there's a case here, the Watkins case. All right? What happens in Watkins? Jared. All right, guy wins the lottery, and is this good news for his life? Is it? What do we know about most lottery winners? I don't know. I didn't hear uniformity, but they're miserable, all right? Statistics show that 75% are miserable, and I know what you think because I think the same way. I'd be different, okay? I'd be able to handle it better. But the reality is most people who win the lottery aren't happy, and I'm not sure if this is really true in this case, but what's one of the first things that happens to our lottery winner? He gets divorced, right? So it's not all bliss, apparently, after having won the lottery. He gets divorced, and what else does he do?
He opts for the 25 equal payments rather than a lump sum.
Does he? I thought he ultimately, I thought he got the lump sum.
After 5 payments, he sells his interest.
Okay, he sells his interest, right? And he says what as a result of the sale?
That's a capital gain.
All right. He says it's capital gain. Everyone see that? He likes to take the position. He looks at Code Section 1221, says, look, lottery winners do not fall within the scope of any of the exceptions, right? And whether Solid said it or not, when you look at Code Section 1221, we said when you're going home this afternoon and you look around in the world, what do we know about most of the world's assets? They're mostly capital assets. So he says, look, I sold my lottery winnings, doesn't fall within any of the enumerated exceptions, therefore what? Says, look, I should have capital gain treatment, right? And that's going to save significant dollars, right? Under current rates, instead of paying 35%. By the way, does New Jersey distinguish between capital gains and ordinary income? Yes, no, on your New Jersey income tax return. Is there any distinction in how you report that kind of income, guys? Yes, no, maybe? No, there is none. All right, just so you know, again, the world has survived with New Jersey not giving a preferential rate. I'm not testing on New Jersey state law. New Jersey largely dovetails from the federal government, but there are important exceptions. I'm just making that observation. So if your clients say to you, oh, do I get a tax break under New Jersey law? The answer is no. But this could save significant dollars. Does the taxpayer prevail here? Probably not, or not, Jared? No, taxpayer loses big time. Why? It's spelled out at the very bottom of the page. Okay, 764, top of 765. Well, we acknowledge the importance of placing appropriate limits on when to apply the substitute for ordinary income doctrine. In the instant case, there's no question that what Mr. Watkins exchanged for a lump sum payment was his future right to receive amounts of income he'd essentially already obtained as a result of his lottery success. In other words, you can't, again, call a duck a swan. And if something is the equivalent of ordinary income, you can't repackage it and try to sell it off and transform its essential nature into a capital asset. And this is really just payments and substitute for ordinary income, right? Taxpayer loses here, and we're not surprised because if the taxpayer prevailed, we as tax practitioners, what would we be doing a lot of? Repackaging, right? We try to take people's otherwise ordinary income and transform, for example, maybe even their inventory sales and try to package it up, or their accounts receivable in some form or fashion that made it fall inside the or outside the nature of being an exception, right, to the capital asset treatment. Doesn't work, all right? And that's why, again, why is this here? Recall what this segment of the chapter is about. It's called the judicial gloss, right, on the statute. So even though you don't see this in Code Section 1221, this is the judiciary augmenting this. And you might say, some people might say, gee, the judiciary is out of bounds, right? That this is judicial activism. If it's not in the code, the judiciary shouldn't be stepping foot on this territory, right? Could that be the position of what you might call conservatives? Well, I don't think so. Why not? Because, you know, if you took that posture that the judiciary shouldn't be active here, what ends up happening is, what would happen to the Internal Revenue Code? It would just grow and grow and grow. You need the judiciary to step in sometimes and fill in the voids, because otherwise what we do to have is just a tremendous tax code, right? Even a bigger tax code than we already have. So there's a role to be played here with respect to the judiciary. All right, let me just give you some foreshadowing. When we pick up, before you close your books, on page 765, we're going to go through these problems, and the chapter continues with more gloss, and then look at page 775. It talks about statutorily created capital gains and losses. So we're going to see areas in which there's capital gains and losses that the statute creates. And then, guys, we're going to get into Code Section 1231, which is, if you recall from the very start of class, one of the most important code sections we have, because our 1231 assets, capital or non-capital assets? Non-capital, okay? Make sure you're emphatic about that. So we are going to be looking at the essential nature of 1231 assets, and then we're going to begin Chapter 22. And we're going to look at and go up to page 799, plus, let me give you a plus here, we're going to look at, on 799, there's the beginning discussion of something called 1245, which I want to spend the last part, let's say the last 20 minutes, last half an hour of class, talking about 1245, because it's so important. 1245 is what I will call, and I think you've heard me say this before, a peanut butter and jelly section. If you recall Code Section 109 and 1019, that the two code sections go hand in hand. When you think of 109, you think of Code Section 1019, right? Everyone agree? You have it in your code book. Let me not stop you. That in your code book, you should have Code Section 109 and written right next to it 1019, and next to 1019, write Code Section 109. Similarly, let me not stop you. Again, these codes have very little resale value. Now, if you guys saw, I think that it's called the movie The Day After Tomorrow, where the world freezes. They did something that I thought was sacrilegious. Do you recall? There was just a very evil line in that movie. Do you recall them? What? Do you recall the movie? Jenna, what happens in that movie?
Don't they, it's survive, right?
But what was the premise of the movie?
It's the next day, when you guys trying to get to his dad.
But what's happening to the world? Why is it ending?
Global warming.
But what happens to the world as a result? It's freezing, okay? Everything is freezing, and you know what they say, like midstream through the movie? They get to a library, if you recall, and what do they say they're going to do in the library? They're going to burn the tax code. I mean, I almost went crazy when they said that line, all right? But my point is, next year, Code Section 1231, guys, you can write down 1245, because when you think of Code Section 1231, you should simultaneously think of Code Section 1245, because those two code sections go hand in hand. All right, so next week, guys, is our final week before the exam. These are the kind of things you're going to have to know. All right, so I'll see everyone next week. Page 799.